Now we will discuss about the chapter number 4, legal and regulatory framework. Now see, up till now we have discussed in chapter number 3 all the concepts and the basics of the mutual fund. In all chapters we will discuss about the basics and concept of the mutual fund, and the syllabus is totally covered in all the different chapters. So please practice all the MCQs and understand the theory thoroughly by listening the video and reading all the concepts, and practice the MCQs very well. So you will definitely pass out the exam and you will get the ARN number. Chapter number 4, legal and regulatory framework. In this chapter we will cover role of the regulators in India, role of SEBI in regulating mutual funds, due diligence process by AMCs for distributors of mutual funds, SEBI advertisement code for mutual funds, investor grievance and redress standards, AMFI code of ethics and AMFI code of conduct for intermediaries. Regulators in financial market of India. Now the regulators are RBI, SEBI, IRDAI, PFRDA. These are under the Ministry of Finance and their role are prescribed by the Ministry of Finance. At a broad level, the regulations in financial markets are driven by the need to safeguard the interest of the consumers of various financial products and services, as well as to ensure a regulated development of the financial markets, which is essential for the growth of the economy. The regulators are Reserve Bank of India, RBI, that regulates the banking system as well as the money markets. Securities and Exchange Board of India, SEBI, that regulates the securities markets. Insurance Regulatory and Development Authority of India, IRDA, that regulates the insurance market. Means it regulates all types of insurance, that is life insurance, health insurance, motor insurance, and all the general insurance categories. Pension Fund Regulatory and Development Authority of India, PFRDA, that regulates the pension market. These regulators come under the purview of the Ministry of Finance. Role of Securities and Exchange Board of India. The 4 major roles are described in the picture. First, SEBI regulates mutual funds, depositories, custodians and registrars and transfer agents, RTAs, in the country. Now the Security and Exchange Board of India, that is SEBI, plays a key role in regulating mutual funds in India, ensuring that they operate fairly and efficiently and protecting the interest of investors. SEBI creates and enforces rules and regulations to protect investors and maintain market integrity. SEBI monitors and oversees mutual funds to ensure they comply with its rules. This includes the formation, administration, and compliance of mutual funds. SEBI establishes a framework to protect investors' interest, including issues like investment objectives, investment methods, disclosure standards, and asset valuation. SEBI takes steps to promote the growth of the mutual fund industry. Now, the second comes the depositories. Does SEBI regulates the depositories? Then the answer is yes. The Securities and Exchange Board of India, SEBI, regulates depositories in India. SEBI regulates the operation of depositories, including the National Securities Depository Limited, NSDL, and the CDSL, that is Central Depository Services Limited. SEBI has framed guidelines for the establishment of depositories in India. The Depository Act 1996 provides a legal framework for the establishment of depositories in India. Now comes custodians. Custodians are SEBI registered market intermediaries, primarily responsible for safekeeping of securities such as shares of their clients. The custodian may hold stocks, bonds, or other assets in electronic or physical form on behalf of its customers. Custodians are clearing members but not trading members. They settle trades on behalf of their clients that are executed through other trading members. A trading member may be assigned a particular trade to a custodian for settlement. Registrar and transfer agents, or RTA, assist mutual fund companies in getting the record maintenance. In short, RTAs offer investors a reference for mutual fund investment based information. The private firms are registered with SEBI or Securities and Exchange Board of India. Registrar and transfer agents are entities registered with the Security and Exchange Board of India, that is SEBI. Every asset management company AMC is required to appoint a registrar and transfer agent RTA unless they have an in-house RTA. Second role is the regulations covers three important aspects. First is the disclosures by issuers of securities. It means that to disclose all pertinent facts about their businesses to the public. Mutual funds and publicly traded companies are required to disclose all pertinent facts about their business to the public. Disclosure documents can include quarterly and annual financial statements, prospectus, management information circulars, and management's discussions and analysis. Full disclosure prevents agents with inside information in the market from misusing it for personal gain and profit. It also prevents the chance of window dressing and manipulation of accounts, thereby further increasing transparency in the market. Then is the efficiency of transactions. Mutual funds offer professional investment management and potential diversification. They also offer three ways to earn money. Dividend payments. A fund may earn income from dividends on stock or interest on bonds. Mutual funds offer tax efficient investments options compared to fixed deposits. Profits from mutual funds or capital gains are subject to tax. Factors affecting mutual fund tax include fund type, dividend, capital gains, and holding period. Returns in mutual funds come from dividend and capital gains, both taxable. Then is low transaction cost. The mutual funds involve making transactions on large number of stocks and bonds rather than investing on an individual stock or bond. So if the investment is made on large number of stocks, the transaction cost gets reduced. Because a mutual fund buys and sells large amounts of securities at a time, its transaction costs are typically lower than what you would pay as an individual investor. The third role is the preamble of SIB describes its basic function as to protect the interest of investors in securities and to promote the development and to regulate the securities market that we have already discussed. Now the fourth major role of SEBI is deliberate speculation in stock markets. Now what does that mean? It means that involving high risk but a chance for substantial gains. The best example of speculation is day trading. Day trading is considered a form of speculation. Day trading involves buying and selling financial instruments such as stocks, currencies, or commodities within the same day with the aim of profiting from short-term price fluctuations. Here the role of SEBI is more important. The Securities and Exchange Board of India SEBI released a consultation paper on 30 July 2024 proposing measures to limit speculative trading in the Indian equity derivative markets. These measures intend to protect retail investors and promote market stability. Insider trading. What is insider trading under SEBI? Insider trading occurs when a person with non-public material information about a public corporation trade in its stocks or other securities. An insider is a person who is a part of the company whose stocks they are trading. They may or may not possess confidential non-public knowledge regarding the firm. Insider buying is the purchase of shares in the corporation by director, officer, or executive within the company. Insider buying is not the same as insider trading, which refers to corporate insiders making illegal stock purchases based on non-public information. Under Indian law, an individual who engages in insider trading may be subject to severe penalties, including prison time. Now, what is excessive risk taken by the mutual funds? Mutual funds offer relatively safe investment options but are not entirely risk free. They are exposed to various risks such as market volatility, sector or stock concentration, inflation, liquidity constraints, interest rate fluctuations, and credit risk, which can impact overall performance. Inadequate collateral by issuers of debt securities. The Securities and Exchange Board of India, that is SEBI, regulates the Indian debt market, including collateral debt funds, and plays a key role in maintaining the integrity and efficiency of the financial markets. SEBI regulates instruments issued by public sector undertakings, PSUs, commercial banks, and listed corporations. SEBI's main objective is to protect the interest of investors and ensure fair and transparent dealings in securities. SEBI regulates other players in the securities market, including stockbrokers and merchant bankers. SEBI investigates and takes enforcement actions against entities that violate securities laws and regulations. SEBI has mandated that fund houses must disclose their portfolio and performance regularly. See, after the scam of Harshad Mehta in 1992 and 1996, between that period, there were many reforms taken place in the securities market. So this chapter covers the regulatory reforms by SEBI. SEBI issued the mutual fund regulations in 1996 in the form of SEBI Mutual Funds Regulation 1996. Since then, there have been many amendments through various regulations and circulars. In all the cases, the objective has always remained to protect the interest of the mutual fund investors and to empower investors to take informed investment decisions. The regulations has covered many aspects such as investor services, accounting of NAV, valuation norms, disclosure and investment norms. Now let us discuss different types of regulation categories. Scheme related documents. Scheme related document, that is SID, is a legally mandated document that helps investors make informed decisions by outlining the fund's operations, management and expenses, including details about the fund manager, fees and tax implications. Scheme information document is one of the many fund offer documents and is almost all the information about a mutual fund scheme. Details like what are minimum subscription amounts, exit and entry loads, SIP details, fund managers and their experiences, risk level, the objective of the scheme, etc. Thus, a scheme information document is a document that provides investor with information about the mutual fund scheme. It is an important document for investors to read before choosing a mutual fund scheme. According to SEBI, the SID should be updated every 6 months. The SID offers comprehensive details on asset allocation, investing approach, risk considerations of the mutual fund scheme. It reveals the kinds of securities the fund may invest in and how it plans to accomplish its objectives. For the schemes launched in the first half of the financial year, the SID shall be updated within 3 months from the end of the financial year. However, for the schemes launched in the second half of the financial year, SID shall be updated within 3 months of the end of the subsequent financial year. It also includes the details such as minimum subscription amounts, exit and entry loads. Number 2. Conversion and consolidation of existing schemes. That is, merger of mutual fund investment schemes. Mutual fund mergers occur when two or more mutual fund investment schemes or plans are combined to create a new scheme or are merged into an already existing fund scheme. Now, what is the reason for the mutual fund merger? The regulatory guidelines by SEBI, which prohibits asset management companies AMCs from having overlapping similar schemes to avoid clutter for investors, are one of the main causes of mutual fund mergers in India. The other factors are rationalization of cost, holding on to assets, redemption anxiety, merging of opposites, insufficient and inadequate performance. Now, what is the role of SEBI here? SEBI's prominent regulation in case of mutual fund merger. Number 1. Investors should be given an option to leave with a 30-day notice period. 2. To enable investor to make a well-informed decision, the following pertinent information should be provided. The most recent portfolio of the scheme in question. Information on the financial performance of the aforementioned schemes since they were first implemented, along with the comparison of relevant benchmarks. Details on new combined schemes, characteristics, asset allocation and investment objective. Grounds for allocating new units using a numerical example. Proportions of total non-performing assets and total liquid assets compared to net assets for each scheme and the consolidated scheme. The unit holders take consequences of the consolidation. Additional disclosure that the trustee may require. Additional disclosures that the board may require. Number 3. Investors are not required to pay any exit load if they decide to exit. Next, new products. These regulations govern the new product categories that may be approved from time to time. For example, in the recent past, there have been products launches under the new categories such as infrastructure debt funds and ESGS. Number 4. Risk management system. It mandates exposure limits for investment by mutual fund schemes to ensure that investors get a diversified portfolio and the schemes remains true to label. For example, if a scheme is mentioning equity fund, then as per current SEBI mutual fund regulations, an equity mutual fund scheme must invest at least 65% of the scheme's assets in equities and equity related instruments. Mutual funds are repositories of large volume of client data. Also, huge sum of money are involved in the investment through mutual funds. Therefore, robust operational risk management systems are warranted, and SEBI has issued detailed guidelines for governance of these aspects. SEBI regulations and circulars also mandate exposure limits for investment by mutual fund schemes to ensure that investors get a diversified portfolio and schemes remain true to label. Disclosures and reporting norms. Mutual funds are among the best investment vehicles, and one of the reasons for this is the transparency factor. SEBI has issued many guidelines to ensure proper disclosures and reporting norms. These norms mandate the different kinds of disclosures along with manner and frequency of reporting. In many cases, SEBI has provided the format in which disclosures must be made such that the investor gets appropriate and adequate information in timely manner to enable the investor to take an informed investment decision. On 5th November 2024, the Securities and Exchange Board of India, that is SEBI, issued circular which introduces significant updates to mutual fund disclosures aimed at enhancing transparency, investor comprehension and standardization across the industry. These changes scheduled to take effect on December 5th, 2024 address three main areas: expense and returns disclosure, a new color-coded riskometer, and a standardized format of communicating risk level changes. Under the updated framework, the mutual funds will be required to provide separate disclosures for total recurring expenses in both direct and regular plans. Additionally, half-yearly returns and compounded annualized yields will be shown separately for each plan. This enhanced transparency allows investors to make more informed decisions by comparing the cost and returns associated with each option. To ensure consistency across the industry, the Association of Mutual Fund (AMFI) will work with SEBI to finalize the standardized format for this half-yearly financial statement. Governance norms. These provisions are very exhaustive and cover many areas of governance, from fund level governance norms that include formation of audit and valuation committees, role of independent directors and trustees to scheme level governance norms that include minimum number of investors in the scheme, benchmarking of the scheme's performance, systems audits of mutual funds to the role of mutual funds in corporate governance. Whenever question arises about mutual fund governance, industry insiders bring up the three-layer structure that is supposed to ensure that unit holders' interests are protected. So, by SEBI regulations, every mutual fund has the sponsor who has skin in the game. An asset management company AMC that manages your money with the help of CEO or CIO and an entire team which reports to the asset management company's board, and then a separate board of trustees to oversee the two other entities. We also have SEBI inspections, internal audits, statutory audits, and any number of compliance requirements. Secondary market activities. These provisions pertain to the secondary market activities by the mutual funds in all the markets: equity, debt, government securities, and derivatives. Example of secondary market transactions. To better understand the concept, let us consider a hypothetical scenario. Company ABC issues new shares through an initial public offer IPO in the primary market. Investors who purchase these shares in the IPO become the primary holders. If one of these investors decides to sell their shares to another investor, the transaction occurs in the secondary market. This continuous cycle of buying and selling creates a dynamic environment where securities change hands based on supply and demand, influencing the market prices. NAV. NAV stands for Net Asset Value. It refers to the per unit or per share value of a mutual fund scheme. It is generally used as an indicator of the fund's overall performance. It is calculated by subtracting the mutual fund's liabilities and expenses from its total asset value and dividing the result by the number of outstanding units. It is usually starts with rupees 10 when an NFO is launched. The NAV is important in mutual funds as it can give a sense to how it has performed in the past. The NAV of a fund is typically declared on daily basis for open-ended funds, which shows the value of fund at the end of each trading day. For closed-end funds, the NAV is usually calculated less frequently, such as weekly or monthly. The NAV is calculated after the market closes each day because when it is open, the transactions are still happening. The NAV of the mutual funds is calculated and declared by the mutual fund house. The values of the asset may not be affected by the market. These are the assets like cash, derivatives. Fund companies typically evaluate the total worth of their portfolio on daily basis, typically after the stock market closes at 3:30 p.m. The next day, the market opens with previous close price, and on the basis of this price, the NAV is again estimated by deducting the expense and liabilities. The cutoff time for both the purchase and redemption of mutual fund units remains at 3 p.m. for the debt and equity mutual funds. However, for liquid and overnight mutual funds, 1:30 p.m. is the purchase cutoff time and 3 p.m. is the redemption cutoff. Valuation. Valuation of various securities in which the mutual fund scheme has invested. The Securities of Exchange Board of India SEBI has announced new valuation guidelines. This move aims to standardize the valuation process, address potential regulatory arbitrage, and enhance transparency in the market. The new guidelines will come into effect on 1st January 2025. Here, the breakdown of the key changes. Mark to market valuation. Previously, repo transactions with a tenor up to 30 days were valued using a cost plus accrual basis. SEBI is now mandating a mark to market approach, meaning the securities will be valued at their current market price. Uniformity and transparency. The shift of Mark-to-market valuation is intended to create a more level playing field for all the mutual funds and bring uniformity to the valuations of money market and debt instruments. This is expected to enhance transparency and protect investor interest. Loads, fees, and expenses. Regulatory provisions impose limits to various loads, fees, and expenses. These provisions also cover disclosure of commission payable to distributors. SEBI guidelines for mutual fund charges. The charges of mutual funds are regulated by the Security and Exchange Board of India (SEBI) with a view to provide greater transparency as well as to protect the interest of investors. In order to enable investors to make an informed decision, SEBI has made it mandatory for mutual funds to disclose their total expense ratio, the cost of operating a fund that includes all charges and fees. It further kept the overall management fee so that the excessive costs do not eat into the returns of investors. These guidelines promote good practices in the mutual fund industry and, even more importantly, boost investor confidence. Dividend distribution procedure. The procedure for distribution of dividend, the norms defining the calculation of distributable surplus out of which the dividend can be paid out, has been laid out in regulations, guidelines, and circulars. In mutual fund schemes, dividends are distributed when the fund has booked profits on the sale of securities in its portfolio. As per regulation, a fund can declare dividend only from the gains it has made from the sale of securities in the portfolio or through any current income in the form of interest or dividends. Firms often pass a part of their profits to shareholders as dividends. Shareholders receive a set amount for each share they hold. Mutual fund investors may take dividend distributions when they are issued or reinvest in the money by buying additional fund shares. Investment by schemes. Guidelines and circulars for investment restrictions and investment limits by mutual fund schemes. Investors invest in mutual fund scheme whose investment objective reflects their own needs and preferences. There are different types of mutual fund schemes like open-ended scheme, close-ended scheme, interval, equity schemes, debt schemes, hybrid schemes, solution-oriented schemes, and many other schemes. Advertisements. As the name suggests, these regulatory provisions govern what the advertisements can cover and what they cannot. The frequency of statutory advertisements, inclusion of disclaimer and risk factors in various advertisements, etc. Advertisements shall be accurate, true, fair, clear, complete, unambiguous, and concise. Advertisements shall contain information which is timely and consistent with the disclosure made in the scheme information document, statement of additional information, and the key information memorandum. No advertisement shall directly or indirectly discredit other advertisements or make unfair comparisons. Advertisements shall be accompanied by standard warning in legible fonts which states mutual fund investments are subject to market risks. Read all scheme related documents carefully. No addition or deletion of words shall be made to the standard warning. Investors' rights and obligations. These provisions cover various matters pertaining to the investor rights, including dispatch of account statements or redemption payouts, penalty in case of delays, instant access facility in case of liquid funds, etc. Service standards mandated by SEBI for the mutual fund. Schemes other than ELSS and RGESS can remain open for subscription for a maximum of 15 days and must allot units or refund money within 5 business days of closure of NFO. In the event of delay in refunds in case of NFOs, investors need to be paid interest at the rate of 15% for period of delay and must be borne by the AMC. Open-ended schemes other than ELSS has to reopen for ongoing sale repurchase within 5 business days of allotment. Statement of accounts are to be sent to investors within 5 days of transaction except in case of SIP, STP and SWP, where it can be sent in 10 days. Statement of account must be sent to active investor regularly on demand at no cost. For dormant investors, it can go with the annual statement. Consolidated statements of accounts across mutual funds based on PAN of the investor must be sent to investor by email every calendar month of transactions in the folio. Investor can choose to hold the mutual fund units in the form of unit certificates or in their demat accounts. The daily NAV must be published at least 2 daily newspapers having circulation all over India, while the NAV and the repurchase price are to be updated in the website of the MFI and the fund by 9 p.m. of the same day. The investor can pledge the units to offer security to the financer. In addition, dividend warrants must be dispatched to investor within 30 days of declaration, while redemption checks must be dispatched within 10 working days. Other rights of investor. Unit holders have proportionate right to the beneficial ownership of assets of the scheme. Investors can choose to change their distributor or go to direct by giving a request for shifting from regular plan to direct plan. In the case of unit holding in demat form, demat statement issued by the DP will be treated as a compliance with the requirement of statement of account. Mutual fund must publish a complete statement of the scheme portfolio and a half-yearly unaudited financial results within 1 month from the close of each half year. Debt-oriented close-ended interval schemes plans need to disclose their portfolio in their website every month by the 3rd working day of the succeeding month. Unit holders have the right to inspect key documents such as trust deed, investment management agreement, RTA agreement, MOU and MOA of the AMC. Certification and registration of intermediaries. Now let us understand what are the intermediaries for mutual funds. Alternatively, investors can enlist an intermediary such as broker, dealer, bank or registered investment advisor RIA to facilitate their mutual fund transaction. This is the intermediary channel. In today's market, most fund purchases are facilitated via intermediaries. Which certification is required for the mutual fund distributor? All sub-distributors and employees are mandatorily required first to pass NISM-Series-V-A mutual fund distributors certification examination conducted by NISM, and second, registered with MFI and obtain ARN and or EUIN as the case may be. Transactions in the mutual fund units. These provisions cover the transactions through stock exchanges and other similar platforms, the kind of documents that the AMC RTA need to preserve, KYC norms, etc. RTA are the special financial institutions that manage and maintains the records of investors' transactions in mutual funds and other securities. They act as an intermediaries between mutual fund companies and investors, ensuring smooth transferring and record keeping. Categorization of mutual fund schemes. SEBI circular on mutual fund scheme categorization and rationalization aimed towards the conversion and consolidation of existing schemes and new products. The objective was to reduce the number of schemes to 1 per category in the open-ended arena so that investors do not get confused. However, that required consolidation through merger of certain schemes with other schemes. The SEBI regulations and circulars detail the procedure of such scheme mergers as well as the disclosures of performance of such schemes. The circular on scheme categorization and rationalization mandated that there can be only 1 scheme per category within the fund house. Various other provisions such as the definition of various categories based on market capitalization were included to bring uniformity. Most mutual funds fall into one of the 4 main categories: money market funds, bond funds, stock funds, and target date funds. Each type has different features, risks, and rewards. Segregated portfolio. During the 2018 credit crisis, SEBI laid down the provision for creating segregated portfolios for protecting the interest of unit holders and giving fair treatment to all investors in case of credit event and to deal with the liquidity risk. In the year 2008, when there was a globally liquidity crisis, SEBI brought many reforms such as dissolving premature redemption in case of fixed maturity plans. A segregated portfolio in a mutual fund is a section of fund schemes that is separated out when a bond issuer in the portfolio fails to pay interest or principal on time. The purpose of segregated portfolio is to protect unit holders and prevent a run on the scheme. So, according to SEBI's rules and regulations, the fund house cannot charge an asset management fee on the segregated portfolio. Redemption in units of the segregated portfolio is not allowed, but they are listed. Segregation can be triggered by rated securities such as when a debt or money market instrument is downgraded to below investment grade. Segregation can also be triggered by unrated securities such as when there is an actual default on interest or principal. Scheme performance. SEBI has mandated that the scheme performance should be compared with the total return index as against the price return index. A price return index considers only the price movement of its constituents and thus captures only the capital gains of the constituents. On the other hand, a total return index considers all dividends, interest, payments that are generated from the basket of components that make up the index in addition to the capital gains. The cash flows are presumed to be notionally reinvested on their X date into the basket of underlying components that make up the index. A mutual fund scheme takes into consideration capital gains as well as the dividend earnings interest income of the instruments in which it has invested while calculating the return generated by the scheme. TRI is more appropriate as a benchmark to compare the performance of mutual fund schemes. Therefore, SEBI stipulated that all mutual fund schemes be benchmarked against total return indices. Then comes mutual funds regulations. Mutual funds regulations cover the applicable guidelines for mutual funds are set out in SEBI Mutual Funds Regulations 1996 as amended from time to time. Mutual funds need to comply with RBI regulations regarding investment in the money market, investment outside the country, investments from people other than Indian residents in India, remittances, inward and outward of foreign currency, etc. Stock exchanges are regulated by SEBI. Every stock exchange has its own listing, trading, and margining rules. Mutual funds need to comply with the rules of exchanges with which they choose to have a business relationship, that is, for listing the units of mutual fund schemes launched by them. Investment restrictions and portfolio diversification norms for mutual fund schemes. Number 1. General restrictions. Mutual fund will buy and sell securities on delivery basis. Securities purchased will be transferred in the name of mutual fund because of respective scheme. Delivery trading means the stocks you buy are added to your demat account. They remain in your possession until you decide to sell them, which can be in days, weeks, months, or years. But mutual funds cannot do intraday trading. For example, the share of the XYZ Limited was trading at 500 rupees share at 10:15 a.m. By 2:15 p.m., the stock price had risen to 550 rupees per share. Mr. Raj is an intraday trader. He bought 1000 shares of XYZ Limited for rupees 500 in the morning when the stock price was 500, and when the stock price went to 550 rupees he sold his shares and squared off his position. By doing this, he made a profit of 50 rupees per share, that is 50,000 profit within few hours. Now, this rule can not be applied in the mutual fund trading because sometimes it happens in reverse form, so there is a loss of money of the investor. So the SEBI has restricted mutual fund industry to buy and sell on the delivery basis only. The mutual fund shall not advance any loans. Now the people has invested lot of money in different schemes. So mutual fund AMCs have lot of money with them. This money they have to invest in the different types of schemes as per the objectives. They cannot advance this money as a loan to anybody. Scheme may invest in other schemes of same mutual fund or other mutual fund. This will be limited to not more than 5% of net asset value of the scheme. So, can the mutual fund invest in other mutual funds? Yes. Some investors prefer even more peace of mind by purchasing a mutual fund that invests in other mutual funds. They get the added protection of multiple money managers and much more diversity than one fund would give them. This will be limited to not more than 5% of the net asset value of the scheme. No fees will be charged on such investments. This does not apply to the fund of funds. Number 2. Investment in debt securities. Now, what are the restrictions of investment in the debt securities? Let us understand that. A mutual fund scheme shall not invest more than 10% of its NAV in debt instruments comprising money market instruments and non-money market instruments issued by a single issuer, which are rated not below investment grade by a credit rating agency authorized to carry out such activity under the Act. Such investment limit may be extended to 12% of the NAV of the scheme with the prior approval of the Board of Trustees and Board of Directors. Open-ended debt funds have to maintain a minimum of 10% of their corpus in liquid assets. Now, what is liquid assets? Liquid assets means that have been defined as cash, government securities, T-bills and repo on government security. Parking of funds in short-term deposits with all scheduled commercial banks shall be limited to 15% of net assets of the scheme. This can be raised to 20% with the approval of the trustees. No management fee will be charged for such investments by the scheme. The scheme cannot invest in short-term deposits of bank that has invested in the scheme. A mutual fund scheme shall not invest in unlisted debt instruments, including commercial papers, except government securities and other money market instruments, provided the mutual fund schemes may invest in unlisted non-convertible debentures up to maximum of 10% of the debt portfolio of the scheme, subject to conditions as may be specified by SEBI from time to time. Investment in equity. See, there are restrictions pertaining to investment in equity. All investments by a mutual fund scheme in equity shares and equity related instruments shall only be made provided such securities are listed or to be listed. ELSS notification requires that at least 80% of the ELSS funds should be invested in equity and equity related instruments. ELSS means equity linked savings scheme. Scheme shall not invest more than 10% of its NAV in the equity shares and equity related instruments of a company. The limit is not applicable for instruments in index, sector, industry specific schemes. Investment in REITs and INVITs. What are REITs and INVITs in India? REITs invest in income generating real estate properties, while INVITs focus on infrastructure projects like roads and power plants, generating revenue through usage of fees or tolls. No mutual fund under all its schemes shall own more than 10% of units issued by single issuer of REIT and INVIT. No more than 5% of its NAV in the units of REIT and INVIT issued by a single issuer. The limits mentioned above are not applicable for investment in case of index funds or sector or industry specific scheme pertaining to REIT and INVITs. SEBI Advertisement Code for Mutual Funds. Advertisement shall be accurate, true, fair, clear, complete, unambiguous, and concise. Advertisement shall not carry any slogan that is exaggerated. It should not be over. It should be too true to the facts. Suppose a scheme is mentioning that it is a balanced fund, then the proportion of the equity and other securities should be balanced according to the scheme agreement, which is mentioned in the SID document, and the advertisement also should be according to that particular scheme. There should be no exaggeration. No misleading, biased, or deceptive statement is acceptable in advertisement. Now, you can never say that mutual fund returns are guaranteed. This is misleading to the people, as mutual fund investment are only subject to the market risk. Extensive use of legal terminology or complex language should be avoided. It shall contain information that is timely and consistent with the disclosure made in the scheme information document, statement of additional information, and the key information memorandum. Whatever is advertised should be mentioned in these three documents of the scheme. Advertisement shall be accompanied by a standard warning in legible fonts which states mutual fund investments are subject to market risk. Read all scheme related documents carefully. The celebrity endorsement shall not promote any particular scheme of any particular AMC, because there is a restriction by SEBI. Advertisement guidelines for mutual funds in terms of disclosing performance related information of mutual fund schemes. Here is the example of the large cap fund. When the mutual fund scheme has been in existence for more than 3 years, performance advertisement of the mutual fund scheme shall be provided in terms of CAGR for past 1 year, 3 years, 5 years, and since inception. Point-to-point returns on a standard investment of rupees 10,000 shall also be shown in addition to CAGR for the scheme to provide ease of understanding to retail investors. It should be clearly mentioned whether the disclosed performance is of regular or direct plan of mutual fund. A footnote should clearly mention that different plans have different expense structures. If the fund manager has managed the scheme for the full period for which the information is being published in the advertisement, the same should be disclosed in the footnote. Where the scheme has been in existence for less than 6 months, past performance shall not be provided. Further, if the scheme has been in existence for more than 6 months but less than 1 year, then simple annualized growth rate of the scheme of past 6 months from last day of the month and preceding the date of advertisement shall be provided. In the case of money market schemes or cash and liquid schemes, wherein investors have very short investment horizon, the performance can be advertised by simple annualization of yields if a performance figure is available for at least 7 days, 15 days, and 30 days. Further, it should not give an unrealistic or misleading picture about the performance or future performance of the scheme. These disclosures shall form part of SAI and all advertisements of mutual funds. When the performance of a particular mutual fund scheme is advertised, the advertisement shall also include the performance data of all other schemes managed by the fund managers of that particular scheme. Such performance data of other schemes managed by the fund manager shall be provided as follows. Performance of other schemes managed by the fund manager along with their respective schemes benchmark shall be provided in terms of CAGR for a period of 1 year, 3 years, and 5 years. In case the number of schemes managed by the fund manager is more than 6 months, then the AMC may disclose the total number of schemes managed by that fund manager along with the performance data of top 3 and bottom 3 schemes in addition to the performance data of the scheme for which the advertisement is being made, managed by that fund manager in all performance related advertisements. However, in such cases, AMC shall ensure that a true and fair view of performance of a fund manager is communicated by providing additional disclosures if required. If a mutual fund scheme has not been managed by the same fund manager for the full period of information being published in the advertisement, the same should be disclosed in the footnote. Further, for the advertisement published in internet-enabled media, mutual funds shall be permitted to provide an exact website link to such summarized information of the performance of other schemes managed by the concerned fund manager. Celebrity endorsement for mutual funds at industry level. SEBI has permitted celebrity endorsements at the industry level for the purpose of increasing awareness of mutual funds as a financial product category. However, such celebrity endorsements of mutual fund at the industry level are subject to the following conditions. The celebrity endorsement shall not promote a scheme of a particular mutual fund or be used as a branding exercise of mutual fund house or AMC. Expenses towards such celebrity endorsement shall be limited to the amount that are aggregated by mutual funds at the industry level for the purpose of conducting investor education and awareness initiatives. Prior approval of SEBI shall be required for issuance of any endorsement of mutual funds as a financial product which features a celebrity for the purpose of increasing awareness of mutual funds. Investors' rights and obligations. Mutual fund investors are entitled to some important rights which are meant to protect the investments and bring more transparency to the mutual fund investors. These rights are bifurcated into two parts: AMC related rights and fund related rights. Some of these rights have been discussed. Right to beneficial ownership. Unit holders have a proportionate right to the beneficial ownership of the assets of the scheme. The investor can ask for the unit certificate for its units holding. Investors also have option to receive an allotment of mutual fund units of open-ended and closed-ended schemes in their demat account. The mutual fund or AMC is bound to coordinate with the RTA and depository to facilitate this. Right to change the distributor. Investors can choose to change their distributor or opt for direct investing. This needs to be done through a written request by the investor. In such cases, AMC will need to comply without insisting on any kind of no objection certificate from the existing distributor. Rights to inspect documents. Unit holders have the right to inspect key documents such as the trust deed, investment management agreement, custodial service agreement, RTA agreement, and memorandum and article of association of the AMC. Right to appoint nominees. The investor can appoint up to 3 nominees who will be entitled to the units in the event of the demise of the investors. The investor can also specify the percentage distribution between the nominees. If no distribution is indicated, then an equal distribution between the nominees will be presumed. Rights to pledge mutual fund units. Investors can pledge their mutual fund units. This is normally done to offer security to a financer. Right to grievance redressal. There is a formal grievance redressal policy for investors. SEBI has mandated that the status of the complaints redressed should be published by each AMC in their annual report. The same should be available on the website of the mutual fund and on MFI's website. It should provide the status of number of complaints received by the AMC, the time taken to resolve the complaints, and the status of pending complaints. The scheme related documents also have details of numbers of complaints received and their disposal. Pending investor complaints can be a ground for SEBI to refuse permission to the AMC to launch new scheme. Rights of investors in the context of change in fundamental attributes. If there is a change in the fundamental attributes of a mutual fund scheme, then the unit holders are provided the option to exit at the prevailing NAV without any exit load. This exit window has to be open for at least 30 days. The trustees or AMC have to send a written communication about the change in fundamental attributes of a scheme to all the unit holders and have to advertise about the changes in the fundamental attributes in the English daily newspaper having nationwide circulation and in the newspaper published in the language of the region where the head office of the mutual fund is located. Rights to terminate the appointment of an AMC. 75% of the unit holders can terminate the appointment of the AMC. Also, 75% of the unit holding can pass a resolution to wind up a scheme. Right to unclaimed amounts. AMC is expected to make a continuous effort to remind the investors through letters to claim their dues. The annual report has to mention the unclaimed amount and the number of such investors for each scheme. Recovery of unclaimed amounts by the investors is as follows. If the investor claims the money within 3 years, then payment is based on prevailing NAV, that is, after adding the income earned on the unclaimed money. If the investors claim the money after 3 years, the payment is based on the NAV at the end of 3 years. Investors also have right to various services such as receiving account statements of portfolios, half-yearly disclosures, etc. To enhance transparency, SEBI has mandated mutual funds to disclose details of debt and money market securities transacted in their scheme's portfolio, including inter-scheme transfers on a daily basis with a time lag of 15 days in a prescribed format. Proceeds of illiquid securities. It is possible that security was treated as wholly or partly non-recoverable at the time of maturity or winding up of the scheme. The security may subsequently yield a higher amount of the scheme. Treatment of such excess is as follows. If the amounts are substantial and recovered within 2 years, then the amount is to be paid to the old investors. In other case, the amount is to be transferred to the investor education fund maintained by the each mutual fund. Due diligence process by AMCs for distributors of mutual funds. Asset management companies and the mutual funds are regulated by SEBI through the SEBI Mutual Funds Regulations 1996. The AMC are vested with the responsibility of regulating the practices of the distributors. As part of that process, the AMCs are required to conduct due diligence on their distributors. SEBI has issued a circular regarding the process of carrying out such an exercise. Next, investor grievance redress mechanism. In the event of any issue with the AMC or mutual fund scheme, the investor can first approach the Investor Service Center. If the issue is not redressed, then even after taking it up at senior levels in the AMC, then the investor can write to SEBI with the complaint details. SCORES SEBI Complaint Redress System. SEBI Complaint Redress System is a web-based centralized grievance redress system of SEBI.